Today we're answering the question at hand. Can you have more than one hedge fund? By the end of this video, you'll learn the benefits of investing in multiple hedge funds rather than just one. How a multi-fund strategy can help protect and grow your wealth in any market condition, and why the most sophisticated investors use this approach to build their portfolios. Investing in one hedge fund generates returns. Investing in two hedge funds creates opportunities. Three or more, well, now you're entering the realm of institutional level investing that most people never even consider possible. The question isn't can you invest in multiple hedge funds, it's why wouldn't you? Just an idea. The world of hedge fund investing isn't what most people think. While everyone is focused on finding that one perfect fund, successful investors are executing a completely different strategy. They understand that limiting yourself to a single hedge fund is like, trying to build a house with just one tool. Let's clear something up right now. There's absolutely no legal limit on the number of hedge funds you can invest in, none. I also need to clear up right now, I am not giving anybody any financial or legal advice. I'm not a financial advisor. I just do some research and I share it with you. The single fact changes everything about how wealth can be built in today's market with multiple fund investing. Let's get something up front right now. There's absolutely no legal limit on the number of hedge funds an investor can invest in. There's none. This single fact changes everything about how wealth can be built in today's market. You see, each additional fund that an investor adds isn't just another investment. It's another engine of potential wealth generation. Look at how the most successful investors actually build their wealth. They're not gambling everything on a single strategy. Instead, they're crafting sophisticated portfolios where each fund serves a specific purpose. One fund might be spotting hidden gems in the market, while another capitalizes on global economic shifts. A third might be using advanced technology to capture opportunities that human traders can't even see. But here's what makes this approach truly revolutionary. It's not just about chasing higher returns. It's about building some stability through strategic diversity. When market conditions shift and one strategy faces challenges, another strategy might be entering into its prime, we'll say. This isn't just basic diversification. It's sophisticated risk management that can work in any market environment. The power of this approach becomes crystal clear during market volatility. While single strategy investors often find themselves at the mercy of market swings, multi-fund investors can potentially profit from these very same movements. They're not just surviving market shifts, they're positioned to potentially thrive through them. Think about the last major market shift that shocked the financial world. While some investors watched their single strategy investment struggle, others, they remained remarkably stable. The difference wasn't luck, by the way. It was strategic positioning across multiple hedge funds. This brings us to the core of the multi-fund strategy. Most hedge funds specialize in specific approaches. For instance, long-short equity funds capitalize on both rising and falling stocks. Global macro funds profit from economic shifts and policy changes. Real estate hedge funds, they focus on multifamily properties, generating returns through both appreciation and steady rental income. But the magic doesn't happen in isolation. When properly selected, these funds create synergies that can enhance your overall returns. It's like having, multiple safety nets, each catching opportunities that the others might miss. The power of this approach becomes crystal clear during major market events. When stock markets crash, and they do, your real estate fund might be generating steady rental income. When interest rates shift, your macro fund might be capturing opportunities that others miss entirely. This is exactly why limiting yourself to one hedge fund can be riskier than most people realize. You're not just missing opportunities, you are potentially exposing yourself to unnecessary market risk. The most sophisticated investors understand this intuitively. They know the true strength comes from strategic diversity. The multi-strategy approach also gives you something else: negotiating power. When you're working with multiple funds, you often gain access to better terms, more information, and stronger relationships with fund managers. You become part of a more sophisticated investor class, we'll say. But let's talk about what it really takes to access these opportunities. Well, the truth is you need significant capital. Most hedge funds require minimum investments ranging from $500,000 to several $1,000,000. And when you're investing in multiple funds, these numbers multiply very quickly. You also need to qualify as an accredited investor for each fund. Now, this means having a net worth exceeding $1 million, excluding primary residence, or annual income above $200,000 or $300,000 with a family member or spouse for 2 consecutive years. Now, if investing in multiple hedge funds is so powerful, why isn't everybody doing it? Well, the answer reveals another layer of this sophisticated strategy. Most investors face 3 major roadblocks when trying to access multiple hedge funds. First, there's the obvious capital requirement, and when you're looking at a minimum investment of $1 million per fund, you need serious capital to start building a diversified portfolio. And second, these funds aren't advertising on social media or sending you an email newsletter. They operate through carefully guarded networks, often only accepting investors through trusted referrals. Getting access requires connections, reputation, and often a track record of sophisticated investing. They're not searching for investors, investors are searching for them. But the most crucial challenge, the one that truly separates sophisticated investors from the rest, understanding how to combine different strategies effectively. It's education, it's knowledge. It's not enough to pick successful funds. You need to select funds that work in harmony, creating a symphony of investment approach that can perform in any market condition. Now, when done right, this strategy can protect and grow wealth in ways a single fund never could. Think about recent market events, currency fluctuations, interest rate changes, technology disruptions. Now, each of these created both winners and losers. The investors who thrived weren't the ones betting everything on a single strategy. They were the ones who understood how to position themselves across multiple strategies. You're not just spreading money around. You're strategically positioning capital across different market opportunities. The key lies in understanding correlation, or more importantly, the lack of it. You want funds that don't move in perfect sync with each other. When the technology sector struggles, your real estate investments, well, they might be thriving. When domestic markets face challenges, your global strategies might be uncovering new opportunities. But let's be crystal clear about something, and it's crucial. More funds don't automatically mean better results. Quality always trumps quantity. The goal isn't to collect hedge funds like trading cards, it's to build a carefully curated portfolio where each fund serves a specific purpose, creating a powerful investment ecosystem that's greater than the sum of its parts. And this is where most investors make their first crucial mistake. They get excited about a fund's recent performance without considering how it fits into their broader strategy. Sure, that fund might have had an amazing year, but what happens when market conditions change? How will it perform in a different economic environment? Smart investors look beyond the surface level returns. They dig deeper into how each fund actually generates its profits. They want to understand what market conditions favor each strategy, and more importantly, what conditions might cause it to struggle. This brings us to another critical point that most people miss entirely. The best time to add a new fund to your portfolio often isn't when it's performing at its peak. Sometimes the smartest moves happen when a proven strategy is temporarily out of favor. While others are rushing for the exits, sophisticated investors are quietly positioning themselves for the next cycle. But there's something crucial you need to understand about managing multiple hedge funds. You can't just set it and forget it. This isn't a passive investment strategy. Market conditions change, and fund managers change. Strategies that worked yesterday, well, they might need some adjustment tomorrow. Successful investors constantly track and monitor their portfolio performance. They're not just tracking returns, they're watching how different strategies interact with each other. They're looking for signs that the market environment is shifting. They're ready to make adjustments when necessary. And speaking of adjustments, one of the most overlooked aspects of multiple hedge fund investing is rebalancing. Over time, some strategies will outperform others. The natural divergence can throw your carefully planned portfolio out of balance. Regular rebalancing helps maintain your strategic positioning and manage risk effectively. So where does this leave us? Where are we? Well, the ability to invest in multiple hedge funds isn't just possible. It's potentially one of the most powerful wealth building strategies available. From traditional market approaches to specialized real estate funds, the opportunities for diversification are vast. But remember, success isn't about the number of funds you invest in. It's about building a strategic portfolio where each fund serves a specific purpose. Whether you're gaining exposure to real estate through one fund while capturing market opportunities through another, it's the combination that creates real power. The sophisticated investors who thrive in today's market understand something critical. They know that limiting themselves to a single hedge fund means limiting their potential. They're not just diversifying, they're strategically positioning themselves across multiple opportunities. The path to successful multiple hedge fund investing isn't always smooth. It requires significant capital, a lot of understanding, and careful management. But for those who can access it, it opens doors to opportunities that are just simply not available through other investment approaches. Think back to where we started. 1 hedge fund generates returns. 2 create opportunities. And 3 or more, well, that's when you enter the realm of truly sophisticated investing. The question is whether you're ready to take your investment strategy to that next level. Well, this is your opportunity to think differently about hedge fund investing, to move beyond the limitations of a single fund approach and explore the possibilities that multiple funds can create. The question isn't whether you can do it, it's whether you will take the steps to do it, and to do it right. The possibilities are out there. It's up to you to decide how you'll pursue them. But my team set up a special deal alerts hotline. And if you want to get on that list, just click the link in the description that says Deal Alerts Hot List. Thank you for driving and diving into this exploration of multiple hedge fund investing with me. If you got some value out of this video, be sure to like and subscribe, and be sure to click the bell, right, to get notified when I post new videos. I'll see you in the next video. You can access it right here. Take care.